Welcome to APREA TV. My name is Yvonne Siu and I'm with Capital Land. I'm responsible for private funds product development as well as the private wealth segment. With me today, most excited to have Ning Hao as well as Russell. Both of them have been very well established in their family offices and driving real estate transactions within the families. I'm just going to have a quick introduction of have both of the gents give a brief background of themselves as well as their responsibilities within their family offices, and perhaps also let us know the philosophies in terms of investments. Over to you. I'll send it over to Russell right now to kick off. Thanks.
Hello everyone, I'm Russell Wee. I'm a second gen principal at Gene Group. So we are more widely known for our hair and beauty branch, but separately we are actually quite active in the real estate space as well. This is the department where I'm most involved in, and taking care of the broader finance and investment department as well. Thank you very much.
Mm, I'm
Hi,
Ning
Ning
Hao,
Hao. Mm,
Group Managing Director for Whole Group. We are a family office. We've been investing in real estate in Singapore, Australia, and across the Asia Pacific for over 50 years. So as Group MD, my responsibilities are mainly, portfolio management and new acquisitions.
awesome. So how would you both maybe describe your respective families' investment philosophy? And has that evolved, say, in the last 5 years?
Ning
Russ, you
Hao.
want to? Oh, okay. We've been in real estate for over 50 years, and during that time the philosophy has remained quite consistent. We invest in a few areas where we have deep conviction, and where we can create value through operating advantage rather than relying on the market. I guess in the last 5 to 10 years, while the philosophy hasn't changed, we've evolved in terms of how we execute that philosophy. I guess we've become a lot more institutional, systematic in every aspect of the process, from underwriting to asset management, governance, how we look at partnerships. Yeah.
I think I mirror Ning Hao's evolution in the family office space, which is not a surprise, right? I think we all sort of at in Singapore, I think we all entered the real estate space at quite the same time. Uh, so Similarly, I think when we started in 2002. We were actually operators first, so we are more like developers, and that is a philosophy we carry to with ourselves up till today. So we're always operators first and then investors second. How it has evolved is that now we are looking more at um, property as an income stream, especially when you're outside of Singapore. And we are always in a deal that we will not be forced to sell. So ultimately, property, I believe, the edge comes from relationships, and it's very locally driven. This is actually something I had with a conversation I had with several of the institutional guys. And property is one of the unique places where it's very vibrant in the mid-market simply because of how relationship driven it is.
Mm.
And similarly, I think we have institutionalized our processes, not our culture, but our processes in terms of walkaway price, what we're willing to pay, how we underwrite, and how we look at things as well, and how we evaluate partners and other managers of our property. So I think quite similarly to
Yeah.
Ning Hao.
Yeah, so are you both in this instance for real estate it's 100% only, or do you also look across various instruments or products
Real
in
estate
terms of the
is
setup?
the
Yep.
real estate is the core of our portfolio, but as we all know, it's a relatively illiquid asset class. And so we maintain a large portfolio of more liquid income generating assets outside of the direct real estate portfolio, which really serves the function of supporting
Mm.
the less liquid parts and
I think
allows us to take advantage of opportunities as they arise. Yeah.
Yeah, but I think Russell mentioned this point as well about income generation, right? So if we have to
Mm,
bucket
mm,
just now, if we just let pivot down to real estate, then you have got the income generation, capital appreciation, as well as wealth preservation.
mm,
Um,
mm,
what would you think about that and how for your case?
mm. Um, Long-term capital appreciation is our number one focus when it comes to real estate, but it's the income and the liquidity which we get not through real estate, that we use to achieve those aims.
I see what
Yeah.
you mean. Okay. Do you allocate a percentage? Is that how you look at it, or is really
Yeah,
subject to it?
yeah. I guess it is the majority of the portfolio by far
Mm,
is real estate, but when we talk about, say, listed equities, private
mm,
credit, fixed income, that's a big
mm,
part of the family office, which really is complementary to the core business of real estate.
mm. And Russell, for your case, your
I
income
feel
generation is more with how are you thinking? Because I mean, we will come to your both of your
yep.
countries' focus, but generally, if you're looking for, say, dividends and income, right? Would you say that the family office is probably okay? We're looking at some of the whether is it sort of the listed space, whether is it REITs or even some of the key banking stocks, etc., or even tech stocks, for example, for capital position. How would you think in terms of the three buckets and how real estate is playing around alongside with that?
Before I begin, I wanted to say that I think Ning Hao and I must be sharing the same notes because it seems like we have almost the same answers for
I just hope
the
it's the
last two, but
same AI, is it?
definitely. No, but okay, you know what they say in Singapore, right? Singaporeans love two things: food,
Yeah.
real estate.
Mm,
So quite naturally, I think we would have independently evolved um into the same dimension and the same direction. Uh,
mm,
Likewise, real estate is our concentrated core.
mm,
But how we view, so the question is how we view it in terms of income, wealth preservation, and capital appreciation, right?
mhm,
So I
mhm,
think different real estate makes for different cases, and different geographies make for different cases. I think for Singapore real estate, it's quite rare to say that it's an income play, to be honest,
mm, mm,
right? I think our cap rates here are not um, indicative of the underlying asset value, and that's why it's quite a resilient market, and we have very unique economic factors that uh, protects our real estate market, unlike in other geographies. At the same time, if you're in, say, in Japan, uh, the hospitality market there is very vibrant, and then you have a natural hedge against inflation because of the daily repricing.
Mm,
mm,
mm.
So,
mm, mm.
how we see it is that even within real estate, different geographies and different asset classes serve its unique purposes. Yeah.
Actually, to your point about Japan, I've been following your family's
Oh, thank you.
investments over the years, and I just really it's sort of curious as to your journey, right? I mean, would it be fair to say that out of Singapore, your one of the first few key investments is actually in Japan, and maybe you could share with the audience, um, why so, and how has the journey been, and what keeps you keep investing even today, right? When it comes to whether is it inflated financing costs.
Yeah, I think you're right. I think we were one of the early champions of Japan, if you follow our journey.
Mm,
We were there since 2012, and it was really only in the last 5 years, at least in our sub-market, where you have seen, actually broadly speaking, right, the Japanese market has been growing very well. It's finally inflationary, which is actually a good thing for Japan after so many years. So we were there for quite some time, and so why Japan? I think Japan actually mirrors Singapore to some extent, at least in the parts that we would like. So one, it is a transparent market. It's a transparent
Mm.
with very strong institutional quality and institutional rights. Secondly, like Singapore, and to my point about the mid-market, it's a very deep, granular, relationship-driven market. This is where we actually have our edge in, right? When we can build strong, lasting relationships with local partners, to give us the best product, to give us the best land, best location at without the quote unquote foreigner tax.
mm,
So it has the institutional quality as a relationship-driven market. In our niche in particular, which is in the hospitality niche, Japan in the last 5 years, especially since the yen weakness, it has been generating one of the most robust tourism markets in the world. So in 2025, we had the Expo, and that brought approximately, if please excuse me if my stats is not exactly right, but approximately 40 million visitors into Japan. This year and in 2030, we are looking at the opening of the integrated casino, so the equivalent of their Marina Bay Sands.
Mm-hmm.
And I think, we can tell what happened before Marina Bay Sands and
Mm-hmm.
after Marina Bay Sands. Yeah.
Mm.
Mhm.
Yeah.
So would you look at, say, your other sectors within Japan, say whether it's data centers or logistics or even offices, right? Are you beginning to sort of look into these other sectors beyond hospitality, or the family is very focused on just this particular whether it's at hotels or any form of hospitality that you're thinking of in Japan?
So I think we are very focused on like what, I've mentioned to you face to face before, the living and lodging sector, right? That's
Mm,
where our edge lives, and that's what we really know. So
mm,
anything with a bid. With respect to logistics, data centers, and offices, to be very honest, we have no idea. To be very,
mm,
very honest, we don't have the edge there. We don't know the economics of it. We don't know what drives the underlying value. We don't know what drives the underlying ADR. So we try not to touch it. I think for us, and back to your actually original point, we are very focused at what we do, and
mm,
we only pursue real estate or the real estate opportunity when we have a very clearly defined edge in it. So
mm.
anything that has to do with like multifamily, residential, or hospitality, where we actually understand the underlying economics of it, that's something that we would pursue. Yeah.
And the financing costs, I mean, whether is it because of the changes in interest rate environment, what do you think about the entry valuation risk today for Japan?
Entry valuation.
Mm. If let's
Uh,
say you got this asset today and do
yeah.
sort of when you do price, how would you think about it? And also your exit point as well, right? So because I guess to the for family offices, sometimes
Yep.
their tenure is also much longer. What we call it,
It is
you
much
own it
longer.
as a yeah, so it's not like a 5 years or 8 years. So in terms of how you are looking in of basically what we call that the deal underwriting, how do you think about that? If anyone is going to present you a deal today in Japan?
I think back to your original point of how we have evolved, right? And
Mm,
how we think about things. I think we have matured and become a lot more selective over time, especially now. When interest rates are low, you are afforded the ability to be a bit more aggressive, to be honest, right?
mm,
Because the spread is wide. As the spreads tighten between your cap and your interest financing costs, you have to become way more selective. Fortunately for us, we have gotten in already, to be honest. We've gotten in earlier.
mm,
But if I was being presented an opportunity now, I think the number one factor that I'll look at is conservative underwriting of the cap rate and the financing costs. And I would model in the possibility or sensitivity towards further rate hikes because of the way Japan has been going in the last 5 years. And yeah, I think it will continue into that trajectory.
And how are you thinking in terms of currency exposure? I assume you are predominantly still SGD based, right? And your assets or your investments are in JPY. There will also be this FX exposure that you will be subject to as well.
Mhm.
And how do you sort of manage them at this point in
Mm.
time?
Actually, I would say that that is one of the easier questions you've asked me for this session.
Nice.
So thank you for asking me this question. I think naturally in real estate, it's a leverage game, right?
Mhm.
You take leverage on it, and by virtue leverage in yen, you pay back in yen. It's a natural hedge already to begin with. Um, Second thing is that currency swaps right now they're being priced at. I think the interest differential between Singapore interest rates and Japan interest rates it's almost nil right now. So even if you are say starting out in Japan right now and you need to pump in capital,
Mm,
actually it's quite favorable in terms of currency. Because your currency swap is actually very, very favorable right now.
mm,
Uh, I think looking at it in another perspective is that we always have to model the idea that, or we model the idea that Singapore is a quite a strong currency, and I think because of the near policy, I think is Singapore uses our currency to manage inflation, right? Simply because trade is larger than GDP. So in that respect, that's something that we actually have to think about when you repatriate back profits. So ultimately, even if you hedge back in terms of paying back your loans,
Mm.
and even if but you still naturally have some element of a currency risk. So it still has to clear that hurdle rate actually. Yeah. So you have to be a little bit more selective in terms of um yeah investments. Yeah.
Thank you for that.
Mhm.
Ning Hao, over to you. I sort of really sort of curious, right? And I think it's most of the audience
Mm,
may not
mm,
have known about the maybe a quick highlight of the 50-year history from Singapore to Australia, how the family has built the business,
mm,
and maybe to start with, why Australia? I mean, maybe the journey of why,
mm,
how do you end up, how did the group, decide that Australia will be your first port
mm.
of lending?
Yeah, sure. I mean, going back to when my father founded the business in 1969, in the 60s and 70s, even throughout the 80s, the main business was condominium development in Singapore, mainly in the Bukit Timah, Pereira, and Holland Road areas. Did a lot of condominium development there. I think just natural evolution, starting off as a contractor, moving to a developer, and then you start looking at income producing assets.
Mm.
Now, in going back to the 70s and 80s, the Singapore market still wasn't that mature. You didn't have the depth and liquidity of income producing assets that you had in more developed markets like, say, the UK, US, and Australia. And I guess Australia, geographically, time zone wise, was the most friendly. Um, so he came here in 1981, in Sydney, and the initial focus was on in hotels. We had a listed company listed in Australia, through which we own most of our hotels. We sold that to CDL in the 1990s, and then continued investing privately since then. Over time, we've shifted the focus, from hotels and resorts to offices, primarily in the gateway CBDs on the eastern seaboard of Australia. Today, the focus is really firmly on two areas. It's Sydney office repositioning and real estate private credit. Um, we tend to be counter-cyclical investors, both of those sectors. Now, I think a lot of broad negative sentiment. Office has been in a structural downturn since the end of COVID 5 years ago. And, there's been a lot of press about private credit, particularly, with the rise of AI and things like that. And I guess that's created a lot of pricing inefficiencies, even with good assets. And so that's why those um, sectors are on top of our list at the moment.
I mean, you mentioned about private credit, but just to be clear as well, you are looking at real estate debt, right? Financing, right? You're not
Mm,
looking at corporate credit to start
mm,
with, right?
mm. Yeah,
Uh,
I think I guess for this conversation and within our real estate piece, it's very much construction financing for high-end residential.
mm-hmm.
Um, in the family office, we have a big portion of private credit, more corporate type credit. But in terms of direct, it's first mortgage, construction, luxury apartment building.
And in terms of because you mentioned as well in Australia, you don't just focus on Sydney, Melbourne, right? And clearly you have been investing across various key cities as well. Are you also how to say? And you mentioned some of the key sectors. What do you think of, say, the trending or well, I mean, everybody's talking about data centers as a
Mm,
investment, but so what do you think about private wealth or private families, like where most of the coverage that I'm responsible for, how should they be thinking in terms of investing in data centers or
mm.
even other sectors that are kind of, I wouldn't say newish, but probably more nascent, given that its trend is maybe in the last 5 to 10 years or so.
Mm, mm. So we do have exposure to data centers, not directly
Mm-hmm.
through the family office, we have investments in infrastructure funds,
Mm-hmm.
which are very heavy in data centers. We have investment in private credit, which lends to data centers. Um, and and so that's how we are getting exposure. It's not an asset class that, we are familiar with enough at this point to go in directly.
Direct.
And
Mm-hmm.
and so we get our exposure indirectly.
I think that's an interesting point between, I mean, you and Russell, right? I mean, insofar we're talking about direct investments. For both of you, do you guys also allocate to what we call a managed solutions or managed investments with their real estate backed?
Sorry, what
We
do you mean by
That
that?
means you've met like what Ning Hao has mentioned, that is managed solutions. That means you have got a GP or a
Oh, okay,
sponsor,
okay, sure.
yeah. Instead of
Now,
being direct investment where you buy assets, right? And then you try to manage it yourselves.
mm, mm.
yeah,
Yeah, very much so.
Mm,
In areas where it doesn't make sense for us to build out a team where we don't have the local knowledge, but we believe in the sector, we work with GPs. Yeah.
mm,
I think similarly, right? I think it depends on where your edge is. I think it keeps going back to what you know and your circle of competence and where your edge lives. And yeah, if it's an area that we do have a belief in, I think Ning Hao has also mentioned private infrastructure funds
mm-hmm,
where you have the least amount of control. Yeah, I mean, you're just simply
mm,
an LP, right? We still go into
mm,
that
mm-hmm,
because the infra play right now is such a strong play, especially in DCs in terms of
mm,
electrification.
mm,
And that's something that we really believe in, but at the same time, we do not have the knowledge or the know-how to do it, right? So
mm.
the only way we can get into that is through private infra funds that exist. But yes, also in terms of like co-investment with a GP, with a majority GP, or even a minority GP, um, this is something we also do as well, where they have an edge and more local know-how. I think it makes a lot of sense. Yeah, I think ultimately it's how how do you justify that returns and yeah.
So given the volatility today, right, for both of you, say in the next 5 years, is there any specific investment theme you are wildly excited about and one you are avoiding?
Ning Hao,
Mm,
I want to copy you.
It's easy,
yeah.
easy question. It's
This is
just
the same. No, I'm just joking.
wildly
No,
excited,
no.
avoid, wildly
Yeah,
excited. And
yeah,
also it could be country, right? Because I think
yeah,
you've got one
yeah,
that
yeah,
is very
yeah.
passionate about Japan and one whose roots are in Australia at this point in
Mm,
time. Are you guys looking at new countries, for example? I'm just, yeah.
mm.
You can speak off the cuff and not representing the whole family, it's fine.
As a sector, one of the areas which we've started dipping our toes in is and are very excited about is life sciences and healthcare
Mm,
related real estate, and the long-term drivers are very compelling, both in Singapore and Australia. You have aging populations, people are living longer, increasing healthcare expenditure, growth in biotech. And this is really driving demand for specialist research facilities, clinical treatment facilities, health and wellness facilities. So it's an area we've started putting money in, and are really quite excited about. And for now, the focus is mainly in Asia for us, where we're looking. We've invested in deals in Australia in this sector, but it's something we're looking at Asia-wide. Yeah.
avoiding? What are you avoiding?
Avoiding
Mm.
SpaceX.
Okay.
Finally,
Gotcha.
Ning Hao says something that I will have a different point of view, but so finally, no,
Go ahead, Russell. Yeah,
not in
why
terms
you
of
why okay,
wait,
let's okay, you wanted to talk about, so are you is SpaceX your high conviction and
Let,
so
let's let's not get
wildly
that's not
off
what I meant.
excited?
topic.
That's not what I meant. I don't mean I sit
Okay.
opposite on the table. I
Yeah,
mean
okay.
I have a different point of view.
Okay.
SpaceX, we actually share the same as him.
Mm,
So I think naturally, as a family office, you're looking at very long-term capital,
mm,
and I think we and maybe perhaps it might be the similar philosophy in terms of culture or whatnot in terms of family capital, but we are more pragmatic. I believe so, and so we also agree that SpaceX is something that we do not dwell in. I think um yeah, I don't want to talk too much about it, but I do think that in this type of market, like in this type of stocks, that's not where our edge lives. I think some other players in the market would have that edge, and that's something that we cannot replicate.
Mm-hmm.
Where I do have a different point of view, it's not adversary, but it's just a different point of view. Uh, for us, I think a very good and maybe not, I don't use the word for us, for me, and it's something that
Mm-hmm.
I've been pushing internally.
Mm-hmm.
Uh, so I'm not speaking on behalf of the family, but on
Great.
behalf of
Yeah, it's
myself.
fine. Yeah.
Yeah, so just to get to the point, it's
Yes.
digital infrastructure. Yeah. So I
Okay.
think digital infrastructure, I believe it's an asset class that would benefit regardless of how the world turns out in the next 5, 10 years, to be honest. I think the structural demand is so strong. I think AI, we do not actually, I mean, AI, we do not actually know if the capex, right? The return actually justifies the capex right now, the $800 billion capex of this year. So I don't really know how to value or talk about AI, to be honest. But
Mm-hmm.
what is quite certain is that digital infrastructure powering AI, powering our cities right now, I think that is quite sticky. The AI story is only one half of it. I think the other half of it is that we are entering into a regime or the next 5, 10 years where it is fundamentally sticky. Inflation is fundamentally more sticky. So I think this is a play that will turn out well, regardless of the what happens with the AI, or if AI doesn't generate more productivity, etc., etc., etc. I think this is a theme that is here to stick. So I'm very bullish about digital infrastructure. What I'm not so bullish about, I think it's the same as him. Yeah,
Mm.
SpaceX.
As a stock. Okay. Good to know. But in terms of control, right, based on both your respective roles within the family office, do you still see the traditional need for direct owner? Again, I like to think in terms of pie chart or percentages, right? Is it still the immediate preference for direct control or rather direct deals? Um, Co-investments or like what is it, managed solutions or fund investments, right? That's the three buckets of how I'm thinking about it. So in your real estate world of investing, how would you think about that? Is it still the traditional way of direct as the majority in terms
I
of
think
control?
Mm,
I think that for us, and maybe think how it may mirror this is that the majority still lives in the direct control. About
Mm,
70% is direct control, maybe 20% is co, and then
mm-hmm,
10% is managed solutions. Because
mm,
fundamentally, your 70% is where your alpha can be made, right?
mm.
I guess you're also with your co-investment, but mhm, typically what we have found out is that if you stick to what you know, it tends to generate that returns for you. Yeah.
Great. Think how your side?
I think for us over 50 years of investing, that thinking has evolved. And it's also comes into the question of, do we want to be concentrated or do we want to be diversified? I think when we first started the business, in the early days, it was all about concentration. Concentration and direct control is what built the success
Mm-hmm,
and created the wealth. As the assets have matured, as the business have grown, diversification has become a lot more important in preserving that asset base. And we look at that as diversification within real estate and diversification across asset classes. And that's where we start introducing external managers.
mm.
Yeah.
And you have been successfully able to bring through the journey of time as well, right? To be fair, because you've been
Mm,
doing this in the
mm,
last
mm,
50 years also.
Yeah, and,
Is
and
there
you know, before coming into the business, I spent a lot of time in the institutional world,
mm,
working in private equity. So, I can see from,
get a
pros and
point of view?
cons of,
Yeah.
of both sides. Yeah.
Yeah. And do you think for both of you, in terms of AI and technology, has that been, are you guys basically using it a lot in terms of whether is it investments or deal underwriting or how you adopting it in your family office right now?
Anyhow,
Yeah, it certainly made things a lot more efficient. For a start, we're asset managers, and particularly in Australia versus our headquarters in Singapore, we tend to be more resource people resource light in Australia. Um, and AI has just enabled us, to do a lot more with less people. So it's definitely driven a lot of efficiencies all across the process, from the way we do our due diligence, to how we manage our assets, how we get more out of the assets. I think it's really crept in into every aspect. And these are questions we ask of our service providers also, our lawyers, our accountants, our property managers. What are you using AI for? How are you using AI to do things better? And what information should we be sharing from our database with yours to help
Mm,
us more efficiently?
mm.
I
Uh,
think,
yeah,
yeah,
Russell, go ahead.
mm, I think similarly, I completely agree. AI has made things a lot more efficient, a lot more, things that would used to take weeks to do, take days to do right now, or a day to do, in fact.
Mm,
But where I think I may have a different point of view is that because we probably exist in upstream in the value chain in real estate, right? And because we live upstream, I believe that the edge I mean, to be honest, underwriting is very important. It's pivotal, but I mean, at the end of the day, it's not, to be honest, rocket science. So I think the edge of the deal or development deal still exists in like old school brokering in terms of managing a cost, and that is very relationship driven.
mhm,
And because it's very relationship driven, yeah, I think it's still you can't simply outsource. You can't ask AI, you can't ask ChatGPT, go find us a piece of land or a deal or whatnot. So, or even if you ask them, oh, what's the market price? Because the market price is not the price that you get actually. So
True,
that
yeah.
may not be a good benchmark, to be honest.
Mm,
Yeah, so ultimately, I completely agree that in terms of the underwriting, the more institutional elements of a real estate deal, I completely agree. I think AI has been brilliant at being more productive, more efficient. I think the more gritty stuff, the more nitty-gritty stuff, still takes an element of the human touch. Yeah,
mm, absolutely.
yeah.
So I guess the other question I have for both of you is, we have seen, okay, you've seen the press coverage as well on the fact that in Singapore we have close to 2,000 family offices, right? Great numbers. I think the year on year is like over 40%. I think Hong Kong as well is seeing phenomenal growth of family office setup. I think the numbers were also close to 3,008 or something. If you were going to set up your own family office today, what would be the advice that you'd be giving? Or what will you do differently, right? Versus what has been done by the predecessor.
Mm, mm. Um, I guess for us, we went through this journey sort of about 10 years ago when we started building, let's call it more of a family office outside of our core real estate business. The first thing, rather than, thinking about where we wanted to invest and what we wanted to invest in, I think what I guess we would first have to get right is the investment philosophy. Um, and that, there's no right or wrong answer. Do you
Mm,
want income or do you want capital? How important is management and control? How important is liquidity to you? Who of the family stakeholders, who wants to work in the business, who doesn't? What are your skill sets? Like I said, there's no right or wrong, but it's important that everyone agrees on it, and we look at this generation and we look at the next generation, and we come up with an investment philosophy, and everything flows from there because we use that as our north star. Everything we do, we come back to that philosophy.
Yeah, I think Ning Hao hit the nail on his head. Again, exactly what I wanted to say. Yeah, yeah. At this stage, I feel people would think that I'm just saying this, but genuinely speaking, I think um independently we'll come to the same conclusion.
Mm,
Is that I think you need to write down before you set up a family office, or when you're setting up a family office, you need to write down exactly what is your North Star, what
mm,
governs a buy, governs a sale, what governs a hold.
mm,
Yeah, who wants to work inside, who wants to work outside, what's the distribution policy, what's the goal, capital appreciation versus income versus wealth preservation, so on and so forth.
mm,
Um, I think looking back, that is single-handedly the most important thing actually. And because I think once you have that right, and assuming everyone follows that direction, I think more often than not, things would go according to plan. Yeah.
I would just say that for family offices, you have a certain I would say strength or benefit versus the institutional capital. Do you face this also from, say, external consultants or groups, maybe preferring to deal with institutional capital rather than family offices? Do you get that, for example, in Australia or in Singapore or in both of your encounters when you are evaluating transactions?
I think absolutely actually. I think one thing family capital has over institutions is the idea of permanence. I think when we look at things, we can look at things very, very, very long, not just in one generation, two, three generations. The second thing is that because of this permanence, we are not afraid of short-term results, quarterly, annually. We are able to look into decades, in fact. So I think because of this, we are able to hold cash, and we're only able to deploy when it meets, our hurdle. And because of this, I think being patient capital, you do have that ability to be much more selective in terms of your
Mm,
investments, and also you're not really afraid of underperforming 1 year or 1 quarter or whatnot. You really can see for the long term.
mm.
I mean, yeah.
Mikhail, your views?
I guess
I'm
having
sure you get that a
having
lot.
yeah,
Yeah,
no, I mean having
go
come
ahead.
from both sides, I worked in New York with a private equity group for 10
Mm,
years before joining the family business. And I think it's not so much, I agree, permanent capital is important, but when we look at asset, we don't look at holding it forever. We don't look at holding it for 10 years. And I think that's something that sort of institutional discipline, have a budget, have a time frame when you want to execute the strategy, have a time frame of when you want to exit. That's something we've changed about the way we underwrite and look at deals. But we don't have to. And I think it's more the flexibility that a family office has that an institutional capital doesn't have, that, let's call it freedom. Freedom
mm,
to change your strategy midway through, the freedom to put more capital in during a stress period in a good asset, um, the freedom to buy or not to buy, to sell or not to sell. I think it's the freedom to make those decisions that differentiate a family office from an institution. But there's so much that we've learned
mm.
from the way institutions do things that has made us better, make better investment decisions.
Mhm.
And in terms of partners, right, if you look at some of the GPs that you worked it with beyond the, again, whether it's a definitely track record, definitely groups that have done significant amount of transactions, returning capital, etc. Um, have both of you also considered developing your what we sometimes multifamily offices or friends and family, which we are also seeing quite a fair bit of such uh, uh, businesses coming up, right? Meaning that usually it's anchored by the one of the families, and then they basically bring people alongside with them and start managing third party capital. Do both of you see this journey coming through to say in the next 2 or 3 years or so?
Ning Hao?
Partnerships is something we've done since the very beginnings of the
Okay.
founding of the business.
Mm,
We've partnered with other high net worth
mm,
families in our investments. Um, um, Over time, yeah. So we're not looking to be an asset manager, but
mm,
partnerships, yeah, we there's a lot of benefit in partnerships,
mm.
networks, capital, diversification. Yeah, so that's something we're very open to.
I think for us, again, I think that's where we have a different point of view. I would never say never, to be honest. I do think that that's the huge theme right now. Everyone wants to be a fund manager in Singapore. I mean, it's true. I mean, if you look left and right, everyone, is opening a fund here and there. But I think it's very important to understand what it means to be a fund manager and be a general partner in the game. because of our experiences, I think you're being the responsibility for someone else's capital is enormous, and it's not something that, because you want to make that 220 or 110 or whatever the fee structure is, it shouldn't be the driving force, because genuinely speaking, you are quite literally a steward of someone else's generational wealth, right? So
Mm-hmm.
I think we are not ready for that responsibility. I would not say never. Um, I think when we are ready, I can confidently say I can deliver this to you at a return above the market. I mean, because it's not above the market, might as well just go with a ETF or whatever, right? Like, or a REIT or whatever. I mean, so unless you're confident enough at generating the alpha, and you have the accountability of um delivering uh in terms of safety and whatnot,
Mm-hmm.
yeah, that's something that I don't think we'll say yes to until then.
Great, thanks. I think it's been wonderful spending time with both of you as always. We'll wrap up this session today, and best of luck for again bringing the family office and investments through
Mm.
this volatile market and really challenging landscape of real estate. So I look forward to connecting with both of you offline shortly.
Thank you
Okay,
so much.
take
Thank you.
Yeah,
care,
thanks,
guys.
Yvonne.
Take
Thank you,
care.
Yvonne.
Good
Good
Bye.
chatting.
chatting,
Bye.
Russ.
As
Okay,
always,
bye.
thank you. Bye.
Bye.